Hi everybody, thanks for joining this presentation today. We're going to be going over the hybrid indexed annuity and really how to create your own personal pension plan. We have a lot of clients and a lot of people that are interested in it, and tell you what, there's a lot of power behind this concept and this strategy, and today we're going to go over kind of a brief education, some of the logistics and variables about how these are designed and how they work. So there are baby boomers, retirees just like you, who come into our office and they have a portfolio and they have designated this money to provide for their lifestyle in their retirement years. So for at least a part of this portfolio, the primary purpose for the money is to keep it secure because they can't afford to lose it. The second purpose is to generate income. They need earning power, money that they cannot outlive, money for life. And the number three priority is a fighting chance against inflation. So that is the purpose of this money. And if we look at the options that we have before us today, traditionally you could choose CDs, you could choose bonds, you could choose stocks, you could choose indexed annuities, you could choose gold. There are various types of real estate. Now, what happens if CD rates stay like this for the next 5 to 10 years? Look at Japan. Japan has been zero to negative interest rates for the last 20 years. So there is a possibility of this happening. And what happens if you said, okay, I need to generate $40,000 a year at some point from my portfolio, and I need to make sure that that $40,000 is predictable and that it's going to be there. Now, if you start putting your money in CDs, you aren't going to get very much, but at least you know it's safe. We start trying to pull out $40,000 a year from this CD, you're going to start losing confidence pretty quick because you're going to see that number start to disappear. You'll start spending less and your lifestyle is going to suffer, and we know that $40,000 and $20,000 is a drastic difference when it comes to your standard of living. Now, there's nothing worse than having to constantly look at your statements, go online, check the Wall Street Journal, turn it on CNBC. Now, I don't know about you, but that's not how I envision retirement, and that's not how our clients envision retirement, even if you are able to manage your principal. Now, if you put your money in bonds and interest rates go up, what happens to bond funds? They can go down. Now, we believe one of the next big bubbles could very well be the bond market when interest rates have to start coming back up. Now, whether that's 3 or 5 or 10 years from now, we're going to see. What happens if the market continues to be stagnant and continues to go sideways? We see it going up and up and up, but the bottom line is it needs to go to 21, 24 on an inflation-adjusted basis to get back to where it was in the year 2000. Now, what happens if we look at the indexed annuity where you participate in the upside and not the downside? What happens if the market doesn't make anything? What's the problem with all these? You can deplete your portfolio, which means the income stops. So that's why in the past people would buy personal pensions. They would receive lifetime income streams, or they would annuitize money in a traditional annuity. Now, annuitization is a process of giving up control of your money to an insurance company in exchange for a lifetime income, and we call that committing annuicide because you can't pull that money back out if you need it. So the key word there is control. And studies have been done by banks, hedge funds, investment people, even the federal government that are realizing, hey, we need pension-like income for a part of our portfolio, but we don't want to lose control. So what these companies did is they took an indexed annuity, which gives you the market upside without any of the downside, and they added the personal pension into one, the key features of both. And the way it works is that if the market goes up, you participate in the upside. If the market drops, you don't lose a dime. And it provides a minimum income, which depends on age and when you want to receive it. But for this example, it provides $40,000 a year as a minimum income for the rest of your life, regardless of what happens. If you live to 82 or 92 or 122, it will pay $40,000 for as long as you live. Now, what's great about this is if we pick the right index, your portfolio is growing. And if the market goes up, it is possible that your income can increase. You have increased income that locks in at that point and can never come back down. And that's where you have that fighting chance against inflation. Now, we're going to give you a detailed presentation and answer all of your questions, but here's the point. I can't promise you that CD rates are going to go up. I can't promise you that bonds aren't going to go down. I can't ensure that the market is going to go up forever. I can't promise you that the indexed annuity will make anything. We can look at past history and we can make assumptions on what we think might happen. We can have these great algorithms and these great objectives, but the bottom line is if we have continued problems in the market, the continued volatility, if the Fed continues to hold down interest rates like they said they will, and for the next 5 to 10 years the market is just stuck in the muck and it doesn't perform, and the asset doesn't make anything, even if you aren't risking any of the principal, the problem with this is once the money is gone, it's gone. With the hybrid annuity, even if your income is depleted, they still have to pay you $40,000 for the rest of your life. And that is the purpose of this strategy, that you have a personal pension which has the ability to increase. It has inflation protection adjustment, and the key word in this process is control. And here's what I mean by that. Let's say in 5 years you want to reach in and you want to pull half of it out. You want a boat or a Mercedes, or you want to send the grandkids to college, or you want to go to Italy, whatever you want. Now that's not the purpose of this money, but the option is there. However, if you do reach in and pull half of it out, you can expect that the income is going to drop by half. Or let's say in 10 years from now, CD rates are back at 7 or 8%. So there might be something more advantageous. Guess what? You have control to roll that over to something else. So in the same way that you would buy a mortgage on the house, whether that's a 20 or a 30-year mortgage, you know exactly what the payment is going to be for the life of that contract. It is fixed. If you get a variable mortgage and interest rates go up, your payment's going to balloon. So with retirement income planning, we always plan for the long term. Just like when you're buying your first house and you're trying to pay it off over a long period of time, even if you do decide to restructure down the road, you have that exit strategy. So let's go into some specific examples of how this works, and I believe that this may be the best retirement vehicle ever designed. So here are the terms. There's about 14 companies who offer this. Each company has between 10 and 30 different contracts, and it really doesn't necessarily matter what company it is. It matters what the terms of the vehicle are, and it's called the hybrid indexed annuity. First, it has the market upside without the downside. That's the key. Without the downside. The money is invested into investment-grade T-bills, AAA bonds, commercial real estate. It is very secure. Second, it has an income floor. That is key. What that means is there's a minimum rate of return it can grow by for income purposes. So even if the market goes down or stays the same for 5 to 10 years, you know what your worst case scenario your money will grow by for income purposes. Some floors are 4%. That means the minimum it can make is 4% per year. Some of them go as high as 10%. We get clients that ask, why would one company give 4% and the other 10%? And the reason is because these plans can run anywhere from 1 year all the way to 20 years. Same as a long-term bond versus a short-term bond. You always have access to capital. You can always take out 10% per year. It is liquid for medical purposes, but if you choose a 4-year plan, you might get a 4% floor. If you choose a 15-year plan, you might get a 10% floor. So generally speaking, the longer you go, the better terms you get and the more income you receive. Now, if the primary purpose of this money is to just cash out and buy another property or cars, then you know what? You probably don't want to go out and buy a 20-year plan. But if the primary purpose of this money is for personal pension and your purpose is to draw this money out, knowing that you have an exit strategy with the ability to make changes down the road, then you want to get the best terms possible. Now, there's usually a low cost of less than 1%. Some fees can be more, some can be slightly less, depending on the terms of the contract, but 98% of these contracts have less than a 1% fee. Now compare this to those old traditional annuities where there is no fee, but you have no pension type plan, or the variable annuity where you're going to see 12B1 fees, loads, and other charges that typically can range from 2 to 4%, but you're still subjecting your principal to loss. We think that 1% is pretty reasonable for all the benefits that you're getting. Number 4, and probably the most important feature, it gives lifetime income, money for life, without losing control of the money, meaning that if you needed to pull money out because life changes or you need access to it or you need to restructure for spousal reasons, you don't lose control of the money. And if there's any money left, whether it's a lot or whether it's a little, the remaining will go to the heirs. The company does not keep it. We're not committing annuicide. Now, let me give you an example. We had John who came in and he had $400,000. He was 60 years old. He wanted to wait until age 66 before he retired, and we found a hybrid annuity with the following terms. First, it had a 7% income floor. And what that means is that he didn't need it for the next 6 years. He hopes it grows by more than 7%, but if it doesn't, he knows what his income is going to be in the worst case scenario. So if we did the math here, at the end of year 1, he'd be looking at $428,000. And this is called the income account value. It is important to understand these definitions, and we'll go over them in more detail here in a bit. Year 2, 457,960. And again, this is important because this is 7% compound interest, not simple. It makes a huge difference. I encourage you to Google Albert Einstein and what he said about compound interest. It's very powerful. Let's look at year 3. We have $490,017. And remember, what I'm sharing here is the worst case scenario, the contractual guaranteed worst case scenario. So let's just calculate the rest of the years out here. Year 4, we have $524,318. Year 5, $561,020. And then his golden year here, we have $600,291. Now, John does have the ability to turn off and on the income anytime that he wishes. The longer he waits to elect income, the higher this amount's going to be. So in this particular case, his income cannot be less than $33,616 per year for the rest of his life, and he still has control of that money. In other words, if he wanted to cash out, he could, but of course then the pension would stop. Now, if he wanted to wait a bit longer until age 67 or 68, this would increase the amount he would get. And if he wanted to take it sooner, it would decrease the amount he would get. So it's proportional. Also, John wasn't married, but if he was, he could make sure that this income stays the same for his wife no matter how long she lives. Again, this is the worst case scenario we're talking about. It can't be less, but it could be more. And let me tell you why. There are two charts that you're competing against here. You have your first one, which you're already seeing on the screen here. It's the income account value. That's the one with the minimum 7% floor. But you also have the indexed account value, which is the market value. And these compete against each other. So let's just say that next year the market goes up by 11%. Now remember, they're going to charge that 1% fee that they will take out of the market value. So for net purposes, let's say that you get 10% the next year. That's that market upside without the downside. That gives you $440,000. Now this 440 is going to be greater than the 428. So John gets the greater of the two for income purposes. That means his income could be more, but now it can never be less. Now let's say the next year we have a repeat of 2008 where the market drops almost 40%. If that happens, remember, his money is not in the market. It's a secure investment. But your portfolio would not go down because the market went down. They would still charge the 1% fee. So we'd be looking at $436,000. Now, do you see, though, how in year 2 that 457 is more than that 436,000? John gets the greater of the two values for income purposes. So these two charts are actually beneficial because they compete against each other. Now, imagine he has this pot of money. He knows that worst case scenario, his income cannot be less than $33,000 a year when he elects. Every time he takes that withdrawal out of this portfolio, his income account will go down by the amount he took out. But what happens if at the same time the market's doing incredibly well? Potentially he can have $800,000 in his account by year 7, which would increase his income to $44,000 automatically. Now let's say this doesn't happen, and for the next 6 years the market goes down every year. And basically all he has is this 440 in his portfolio. Well, we know that the minimum income can't be less than $33,000 a year. And even if he continues to live into his 80s or 90s or 100, he draws his income account down to zero, the company is still required to pay until he passes away. Now, let's look at how they kind of determine these payout factors. This is very generic, but it'll give you an idea of how they kind of do it and the power behind waiting a little bit longer. Now, it's very similar to any company pension plan in that it's determined by age, it's determined by gender, and then length of deferral, meaning how long you keep the money with the insurance company. So we take John here. This is just a hypothetical example who put in $500,000. At age 61, he says, you know what, I don't want to wait until retirement age. I'm going to take it all out now, lifetime income. So at age 61, he has $23,468 that he can take for the rest of his life. Not bad. Let's look at age 65. Just by waiting another 4 years, he has increased his lifetime income almost $10,000. Subsequently, if he waits till age 70, he can now take out $48,353. So what they're doing is every year that he gets older and waits to elect his income, they are giving him more by 0.10%. And that can be pretty powerful when you add up $10,000 every year for 30 years. The next square you'll see a hypothetical example of John being married. Everything works the same. If he takes it at 61, he's going to get 20,000. If he takes it at 70, it'll be 43. But here's where the difference is. That number, the annual guaranteed withdrawal payment, is not only for him, but it's for his spouse. So if he's taking 28,906 at age 65 and passes away, his wife will then be able to take 28,906 for the rest of her life. And if they do not deplete everything and she passes away, well, then it goes to their heirs. Remember, the insurance company does not get to keep that money. Now again, this is just a generic example. When you do come in, we'll go over it in depth and we'll go over the specifics. But the bottom line is being able to guarantee your income like this gives you a tremendous sense of confidence and empowerment. Every person is going to be different, and our job is to help find out what your goals are and what is going to make sense for you. These are not for everybody, but for the people that they are for, they can be incredibly powerful. Our address and our phone number is on the screen here. We have a lot of clients that already have met with us, and this is a great way for you to kind of get educated on the basic principles and the variables that entail these hybrid indexed annuities. So please give us a call. Let us know if we can help you, and we appreciate you.